Yep. So we'll just start. We are good to go. Um, Thank you, Ankit, for joining us today and addressing our audience. Um, I'll first start with your introduction for the benefit of our audience. Mr. Ankit Jain is a fund manager with Mere Asset Mutual Fund. He has more than 10 years of professional experience in investment management and fund management. He has been associated with the AMC since 2015. He was previously with Equirus Securities Private Limited, and he manages more than 50,000 crores across Mere Midcap, Large and Midcap, Multi-Cap, and Consumer Fund. Thank you, Ankit, for joining in today for addressing our audience.
Yeah, thanks for the invite. Yeah, my pleasure.
So, Ankit, let's first start with the very pertinent question that is keeping occupied everyone on the valuations. So we have seen the market having a very great run over the last 1.5 year, where the particularly mid and small cap indices have delivered more than 60% returns over the last 1 year. So how are you looking at the valuations in this space, particularly from the mid and small cap perspective?
Yeah, absolutely. I mean, I think you're right. Clearly, we have seen a pretty good outperformance in this segment, and some part of it is justified that post-COVID, we have seen a pretty good broad-based recovery in earnings, and particularly, I think, if you look into, I mean, mid-cap earnings, and even, I mean, I think broad-based earning across large, mid, I mean, uh, there has been pretty strong sort of a rebound, right? I mean, almost 20% plus sort of a CAGR earnings growth is what we have seen after COVID. So one thing is that clearly overall fundamentals has improved significantly across many sectors, so which is giving a lot more comfort. But you look into sector after sector, that overall, I mean, earnings growth is going to pan out, or let's say chances of earnings downgrades are lower. That is what actually has had happened, right? Plus, on top of that, specifically for mid and small cap, sector weightages for some of the segments, like let's say maybe cap goods, engineering, or and even let's say domestic cyclicals and all. I mean, that is high, right? And given government policies and all, PLI and all that, delta change to earnings in some of these segments are higher, right? So, which is obviously, I mean, making one believe that maybe some of these high teens earnings CAGR, or maybe closer to 20% sort of a CAGR. One second, just. Uh, so, uh, so I think those sort of a earnings CAGR is going to pan out. And given the way, let's say, fundamentals are for us, it might as well continue for next 3-5 years also. I mean, generally, we do look at earnings in context of next 1 year, or maybe now 24 is completed, fiscal year 24, so more like fiscal year 26 earnings. Yeah, in that context, valuations are expensive versus historical average. And within that, also, if you try to dissect some of the sectors, cap goods, utilities, and all, valuations are like, I mean, lifetime high, and they might even be factoring in, I mean, maybe fiscal year 27 earnings also into certain cases into account. So how I will see is that overall there are still good opportunities in the market. It is not like everything is expensive. But yeah, I mean, at the same time, I mean, clearly there is a froth. I mean, into certain segments where obviously maybe earnings outlook might be good for next, next look, let's say 3-5 year standpoint also. So it is bit of a, balancing sort of a act one has to do or try to navigate this sort of a euphoric market,
Right.
particularly in the mid and small cap segment as such.
And you manage one of the largest mid cap fund and very popular as well. So how is the sector allocation currently looking like in your fund? So which sectors are you currently overweight and which sectors would you be currently underweight?
Sure. So we are overweight across, let's say, banking, financials, consumer discretionary, healthcare, pharmaceutical, and also maybe auto ancillary, particularly auto ancillary as a space. Some of these areas is what we have been positive on. The sectors where we are, let's say, a bit of an underweight is like, clearly is more like a, and also plus actually consumable. Some of those consumable also we are positive. Sectors we are underweight is like more like a capital goods, utilities, IT also we are more like a marginal underweight as such. Yeah. So
Right.
and also within, let's say, infra theme and all, maybe cement, logistics, these as a space we are more positive on. Also on metals, maybe up to an extent, but clear cut underweight is more like FMCG, IT, and then some of these cap goods and basically utilities as a segment. Yeah.
Right. And one question, particularly for the first time investors that they have in mind when they look at large cap, mid cap, small caps, they don't actually understand the meaning of
Sure.
these market caps. So, what kind of companies are classified as mid caps? What is the size of the companies? Because they are not very large, but they are not also not very small. They have a good
Sure.
scalable size, operating at a scalable size. What is how do we classify any company as mid cap, and what is the typical size of these companies?
Sure. So typically, if you look into, generally, AMFI come out with this list every 6 months, right? So on basis of that, last 6 month average market cap, top 100 companies are sort of a classified as basically large cap. So that list, as on last December, do end at around 65,000 crore. In terms of market cap. Now, June, it is up for review. That 65 might have gone up to more like maybe 75 also. So maybe any market cap will cut off of maybe 75,000 in current context. Yeah, maybe $9 odd billion is, is sort of classified as large cap. And mid cap starts from 101st till 250th. So those are like 150 names as per current definition. And as on last review, the 250th name was ending at around 22,000 crore, which now might have gone up to 27,000 crore. So basically, in current context, you can say typically $3 to $9 billion sort of a market cap is somewhere, let's say, classified as basically mid cap, and then anything below that is sort of a small cap. Typically, it is like, maybe you can say $1.5 to $3 billion is more like a clear cut small cap. Maybe 10,000 crore to basically more like maybe you can say $1 to $3 billion is more like a small cap, and then below $1 billion, people do classify it as a small cap. Also, someone can classify maybe smaller small cap or maybe something like that. So clearly, this universe has widened significantly. If you look into, last 5 year, that $3 billion, the lower end, which I am talking about, more like 27,000 crore, that used to be 30,000 crore at the upper band, right? And that 30,000 crore of upper band is now more like 75,000 crore. So there has been a significant jump, obviously, over time, which is also helping in a way that clearly, which is also is a reflection of overall company's balance sheet. P&L is sort of a improving significantly, and that also in a way now talks about that mid caps are no longer, I mean, that sort of a smaller companies. I mean, it is now very very sizable in that context, and in many of the cases might be having a lot of leaders into certain
Right.
subsegment of the market.
Absolutely. I remember then around December 22 when I was looking at the market caps, it was roughly between 15,000 to 50,000 crores.
Yeah.
Now, as you said, it has gone up to 27 to 75,000 crores. So we have seen that kind of appreciation in the market as well.
Yeah.
Right. And Ankit, when we talk about mutual fund, you have a mid cap fund, you have 150 stocks universe, and then obviously you can have some exposure in large caps as well as small caps. But how do you construct your portfolio? And what is the typical number of stocks? What are the typical number of stocks that you fit into your portfolio?
Sure. So portfolio construction, I mean, ideally is a function of bottom-up stock selection. So one is obviously you keep benchmark reference in mind. I mean, underlying benchmark, which is Nifty Midcap 150 in this case. So you to try to keep that as a reference point more from sector weight standpoint, right?
Right.
So ideally, in order to build diversified portfolio, you might not want to take a very heavy active sector call. I mean, rather build with sort of a diversified approach when it comes to the sector allocation. But stock specific weights can be significantly higher. That is again on basis of our sort of a conviction on any particular name. Higher is the conviction. I mean, ideally higher has to be the active weight. In the portfolio. So that is how typically the approach is being. At the same time, keeping the mandate in mind that minimum 65% weights has to be in the mid cap all the time, and then balance 35% is the flexibility, which depending on the opportunity, I mean, can be in small cap, large cap, and even can be within mid cap as well.
Understood. And typically,
So that is one, and then second on your question of number of stocks, right? So see, I mean, portfolio at the same time should also reflect conviction, right? So rather than going into total number of stock, which might be 70 odd and all, let's focus on concentration around top 10 or maybe top 40. So top 40 stocks still has to be around 75 odd percent ideally. And then maybe below 30 name could be 1% or sub bit of a long tail as
long
such.
tail. Understood. And when we recommend any particular fund, particularly in mid and small caps, we usually recommend clients to have a horizon of more than 5 years. And while as a fund manager, when you're picking a stock, what is your typical horizon from a particular stock? And what would be the typical churn rate around your portfolio?
So we do typically keep, at least 3 years sort of a time horizon in mind while taking initial call, because that is a decent sort of a time frame. Even if any business has to undergo some sort of a cycle, maybe 3 years is a reasonable sort of a time frame for your thesis to play out. Even in case within that 3 year, any sort of a one maybe down cycle also, sort of a comes in. So our approach remains that 3 year 50% upside typically is a good sort of a starting point. Really
Sure.
to look into any one particular name, but at the same time, portfolio churn. Also is like because see, we can own business. For longer term also, as far as it is sort of a delivering on some of the internal assumption until and unless something really go out of the bag. In terms of price value cap as such. But uh, but yeah, I mean, at the same time, portfolio turnover is more like 40 odd percent. So, which is, I will say, uh, is still not very excessive. I mean, is it like something you to churn out too frequently, because 90% of the portfolio still remains quite poor. A tactical portion is actually relatively low as such.
Right, right. Uh, and so now moving on from how the you manage the fund, we as wealth manager always we are thinking about asset allocation. So how on a personal portfolio level, how do you think about asset allocation? Uh, and how are you personally allocating your funds into different asset classes? I'm not talking about specific funds or specific stocks, but on broader on the asset allocation perspective.
So, see, I mean, it. I mean, India is a growing market, so clearly equity as an asset class, I mean, should continue to do well. I mean, in case of time horizon is good, right? So to that extent, yes, I mean, I think equity has to be predominant part of one's portfolio. Within that, clearly, I mean, there has to be a good balance of all the three market cap segment: large, mid, and small. Typically, I mean, I do see a multi-cap sort of a portfolio is a perfect sort of a blend, which can give maybe more like 45-50% large, and then 50% you can play around within
Mid and small.
basically mid and small cap segment. So that remains a pretty good sort of a approach. Someone who is into the maybe early to mid cycle sort of a age, I mean,
Right.
age bucket. And if age moves up, then clearly large cap allocation has to go up accordingly.
Even we on our equity allocation, we also follow a multi-cap approach.
Yeah.
Not at the fund level, but we have a portfolio of 5 to 6 funds where we construct about 40 to 50% large cap and remaining in mid and small caps, where we believe that it provides the better risk adjusted returns when we have a horizon of more than 3 years.
Absolutely.
Right. Ankit, just on the last point on your AMC, if you can touch a little about your AMC
Sure.
for the benefit of our audience.
Yeah, no, absolutely. So Mere is like, I mean, South Korea based company in Korea. I mean, it is started during 1997. So not that old. I mean, it is still sort of less than 30 years. I mean, since inception in India, we are there for last 17 years. So we are seventh largest in terms of active equity asset under management, with total AUM maybe around $20 billion only specific. I mean, basically equity side of it. And typically, I mean, our sort of approach is looking into more like growth oriented businesses, and then try to follow the process of ROI, return on investment, and all of those sort of parameters. So very well defined sort of a process. And by the way, this company in Korea is a very sizable, very equivalent, maybe as like maybe some of these basically HDFCs and all, right? I mean, we are having in India. So it is a very sizable organization globally across different asset classes, not only into equity, mutual fund. They are having passives, real estate, private equity, everything. So yeah, I mean, I think now in India we are for last 17 years and maybe only foreign owned organic, I mean, largest sort of I mean, sort of a mutual fund, maybe except for Nippon and all, which is more like an inorganic. But yeah, from the organic standpoint, we are the largest foreign GMCs as such.
Thank you so much, Ankit, for joining in today
Sure.
and sharing your views on the markets, on the fund, and your AMC. And I personally like the session, and we look forward to doing more such sessions with you and your fund house. Thank you so much.
Absolutely. Thanks a lot
Thanks.
for inviting me, and thanks and very best wishes to your investors. Yeah, thank you.
Thanks. Thanks. Thank you so much.